You wish. Right. So yeah, don't worry about Simon. Simon is just you sharing your thoughts and idea and opinions, right? If you submit your your assignment should be fine. Don't worry. Okay. Right. So let me continue with our discussion. Let me emphasize again the importance of information in financial markets, right? Let's say I'll give you another situation, right? So now there are two potential borrower here. Okay, let's just put borrower A and oh, yeah, I'm not sharing. Oh, okay, okay, all right. So, so I really wish that I'm a student, right? I don't have to share my screen. Okay, let me share the screen. Okay, is it on now? No. Okay, right. So I give. Let me emphasize this again: the importance of having adequate or sufficient information in the financial market so that you can make a decision, right? If you are lenders or if you are investors. Okay, let's say let's put this example in a in a banking practice. So let's say now imagine that you are a banker, right? You 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 basically go through the loan applications and you decide whether you want to lend the money to this two borrower. Let's say there are two borrower come to you and then ask for the same amount of loan. Right? Let's say both of them asking you 10,000. Okay, all right. Uh, and with the same maturity, let's say for the 10 years period. Okay. Uh, and then they are slightly different in terms of their characteristic. All right. So let's say the borrower A, the potential borrower, right? You haven't decided yet to whether to lend to borrower A or borrower B, right? So let's say in the case of borrower A, right? So borrower A is just a fresh graduate, right? He just finished his study, so now he's get a job, right? A very stable job, for example, right? So that he earns, let's say, 5,000 a month, right? And then because he's basically a new and fresh graduate, he doesn't have any financial commitment, right? He's not married, right? He doesn't have any financial obligation. He doesn't have a credit card. He doesn't have any taken any loan previously. So uh, basically, he just earned 5,000, and perhaps he need to pay some rents and also for the foods and to survive until the end of the month, right? And then there come another borrower, borrower B. Let's say, call it borrower B, right? Uh, let's say he's also a full-time worker, right? That earn the same amount of money. Let's say 5,000, and let put this in situation where both of them have the same monthly expenditure, right? Both of them are equal monthly expenditure. Let's say they spend 3,000 a month. Both of them spend 3,000 a month, right? But in the case of borrower B now, he's slightly different from borrower A because he has some loan commitment at the moment, right? Let's say he has a credit card that need to pay 500 monthly, right? He has a credit card here, one, right? And he also have a car loan. Let's say, well, he need to pay 700 a month. So he has a car financing here that he need to pay, right? But this guy, apart from 3,000 monthly expenditure, the rest is basically his disposable income. he can spend whatever money that he has, right? I mean, the remaining money that he has, which is about $2,000 here, right? So now, I give you an example earlier. So now put yourself in as a banker, right? So now you have to decide. So which one that you want to, let's say you can only pick one out of these two borrower, right? So let's say now let's pull the decision together, right? So let me ask Sundus first, right? Sundus, which borrower that you will, as a banker, which borrower that you will lend the money to? You decide the money to borrower A or borrower B? Did I explain the
Borrower.
situation clear? Do you understand the situation now, right? I explained the situation clearly, I hope. Right. So now let's pull the decision, right? So Sundus, which borrower that you pick? Let's say you can only choose one to lend 10,000.
Borrower B.
Yes. Okay. Sundus said borrower B, right? How about Bilo?
Borrower A.
Okay. So we have a two decision here to make, right? Mahmoud, which borrower that you pick? Mahmoud, are you here?
Borrower B.
Borrower B, right? So we have another. So 2 against 1. How about Nias?
Sorry, doctor, I was not here from the beginning, so I could not follow.
Oh, okay. Okay. Then I have to take time to explain again. All right, we skip
No,
Nias.
okay.
Okay, Nias. So you
Okay, please,
you
no
answer.
problem.
You respond to the next
Yes,
example.
yes.
All right, but you will get the point that I'm trying to say here. All right. Munira, you were here, right? Okay. So which borrower that you pick? Sorry. Borrower B, right? Munira said B. So 3 against 1. How about Amira? Amira, which borrower that you pick? Or you were not here as well? Or you are not even here now? All right. So let me ask this. So you have a 3 against 1. Let me ask Bilo first, right? Bilo, why you decide to pick borrower A in this case?
Yeah, I decide I decide to pick borrower A because he has more left after his expenditure. He has like 200,
Okay.
2,000 left, so he
All
can
right.
use that money to pay back
Okay. So
the
so
loan.
by all right, okay, clear. I think the it's a fair justification, right? But whether it's a fair in the perspective of a banker, let's discuss that together. But as a commoners, right? We are all agree, right? In this case, this guy, I mean borrower A, have more money left after at the end of the month because now he doesn't have any commitment, right? Okay, let's hear from let's say hear from Mahmoud, right? Mahmoud, why you pick B, borrower B?
Yeah, I chose borrower B because borrower A has never borrowed the money.
Okay, all right, you're getting there, all right, good, all right.
Yeah, and borrower B is more experienced in terms of borrowing than the borrower A.
Okay, all right. So now you see that's again come the application of the principle, the third principle that we have discussed earlier, right?
Yeah.
Right. So because from the perspective of a banker, right, it doesn't matter how much you left at the end of the month, right? But what matters as for banks, from a bank's perspective, is that whether you are whether you did a good job in terms of settling your commitment every month, right? So in the case of B just now, because he had some loans taken from credit card and also from the car loans, right? So now as a banker, you are able to get the information about his credit history, right? So that information is more valuable for me as a bank, right? So I can argue, right? I mean, what Bailo said just now, yes, is correct, right? But borrower A has a more disposable income, more money left after minusing all the expenditure, right? But I have basically no idea about this borrower A. I don't know him, right? I never met him, right? And I don't know whether he has that tendency of paying back the money, right? Because basically there is no track record of him paying his monthly commitment. Although he has a $2,000 left, right? He might be spending on other things, right? He might not be what we call as a committed borrower, right? Who pay the monthly commitment on time, right? Unlike in this case of borrower B, I have that information now with me because I can go through his credit history, whether he's paying good in terms of the credit card that he borrowed, right? And also the car loans that he borrowed as well, right? So in that sense, the information is more importance in this case as a banker, right? As if you think as a banker, that's the mindset of a banker, right? The information is very important, right? When you want to decide to lend to which party, right? Or you decided to invest the money that you have, right? So do you get the idea now? The concept of this principle number 3, that information is everything for the financial markets. Right.
Yes, it's clear.
Okay. All right. It's clear, right? So now let me extend a bit the discussion in terms of the principle number 4. Principle 4 saying that markets will determine the price, right? Market is a place where people do transaction. I think I have mentioned this in the previous class, right? The function of the role of financial markets. First is of course is a place where people do a transaction, right? Let's say you are a capital provider, you need to find a business venturer or business entrepreneur that have a business opportunity ready, so that you can invest the money to him or to her, right? So this is financial market is a place where people engage, right? You may not realize this because nowadays we were born in the world where we are connected through this virtual transaction, right? So for now, you don't have if you want to open, let's say, a fixed deposit account at a bank, right? You don't have to go to branch now. You can use your mobile apps, whatever, right? If you want to pay, if you want to borrow, even if you want to borrow some money, right? You can do it online now. So you tend to, appreciate less about the importance of the financial markets, right? Because back then, let me share with this, yeah, before we have this e-banking, electronic payment system, right? Those bankers back then, like how they decide to, like, again, come to this situation, right? Where they have to decide which borrower that they want to lend the money to, right? Because they have the responsibility as a banker, right? I need to make sure that this lender have a good is a good paymaster, right? He are able to pay and he willing to pay the loan that he borrowed, right? So how do bankers before? I mean, we are trying to imagine, let's say, 50, 60 years ago, right? How this banker meet this potential borrower, right? So they do like activities together, right? So they meet this borrower through coffee, like they go for coffee, right? They go golfing together, right? And they basically know the person, right? Personally, right? Mostly he know the family, right? The personal banker know the family of this person who asking for money, right? So they know the family connection among the circle of friends, right? So they are very connected in that sense, right? But in our banking system now, we don't have this kind of connection or interaction, like personal interaction anymore, right? Because let's say, let me ask you now, right? Of course, let's say Bailo has some money deposited here in Malaysia because he just arrived, right? Because he need to use the for to pay or to buy things or whatever, right? But I mean, does Bailo know like where his money go to, right? When he deposited the money at a bank? He doesn't know. Of course, he doesn't know, right? That's the job of the banks to find out. And even the banks, I believe that he cannot keep track. I mean, keep track the money trail where, especially this buy low monies, you know, go to which party. He doesn't know because everything is pulled together, right? And then with the virtue of this digital platform and whatnots, so people are becoming less engaged, personally in the financial markets, right? We tend to what we call as underestimate the importance of financial markets sometimes, right? Because these two party come to the market. Let's say this is a market, right? So usually they know they do transaction after they have a transaction together for so many times, right? They engage in several transactions in the past, so they getting know each other better and better every day, right? So that's why you realize that sometimes if you are new, right, like say in the case of this borrower A here, right? I may decide to lend him money, right? In like Bailo decision just now. I no problem. I can lend money to borrower A, but you know what? I will charge him more, right? Because I basically have no idea about him, right? Because I could, again, no information equal to high risk, right?
Yeah.
So, yep, Mahmoud, you're saying?
Borrower is the risk of borrower is higher than.
Yeah, because you don't have previous information about him, right? But as long as after, let's say, next year, borrower A come again to me, right, asking for the same amount of money, right? And then for the past year, he has been doing a good job in terms of repaying me the money back, right? So now I have some information about him. Am I right? I have that kind of information. Right? I know that he's a good paymaster now. Should I reduce the cost of borrowing to him? Should I reduce the interest rate that I charge to him? I should, right? Because so that's the job of financial markets, right? Where people do a transaction more frequently, as people do a transaction more frequently, right? So they know each other better, right? And then this will lead to what? A reduction in a transaction cost, right? Meaning that for the same person, bank doesn't need to spend money to find out information about him anymore because he has a good credit record with the bank now, right? So if the same borrower come again asking the loans from the same bank, the bank may decide to give him a better rate, right? Lower rate, slightly lower rate, again and again, right? And so this is the job of financial markets, that they determine the price. I think I mentioned to you about the role of financial market for price discovery, right? Yes, where people meet and then people engage, people do transaction, and then you will decide the price there. So that's the job of financial markets, right? So we might think that a financial market is just a place for people to buy goods and sell goods, right? Or sell financial instrument, but we don't realize this as much if you don't read about finance, right? This is the more important role of financial market, price discovery, right? It's very important. Any questions so far if you want to ask? So you get the point what I'm trying to say here about this price discovery, or are you lost somewhere?
Like, doctor, the price discovery is about the rate of the interest rate.
Yes, yes. The one of it, right? Because in finance it's all about that, by law, right? It's about how you value the assets, right? If you think about that, because this financial contract or financial assets changing hand like so many times, you don't know, right? One bond has been changing hands so many times, right? Even in one day transaction, if you accumulate the one day transaction that happened in financial markets, it could reach 1 trillion. I'm afraid so, right? So because of this frequent transaction, if now the volume of the transaction will be higher because we have this digital platform and whatsoever, right? So you should expect that the volume of the transaction in the financial market is going to be higher and higher from now, right? Even if you compare from the past 10 years, for example, right? Have you heard? I mean, for locals, I think you heard. I mean, you follow this case of CIMB Bank, right? Just for those who doesn't know about this case, right? CIMB Bank is one of the largest bank in Malaysia, right? So recently, when was it? I think 2 or 3 months ago, there was a disruption in their banking, what we call this online banking apps or their website, right? Some people couldn't log in, right? Some people suddenly realized that they lost their money, right? Suddenly their deposited amount of money become negative, right? And then people dig out what happened to this CIMB account, right? Why I cannot even withdraw my money during that time. So people link that problem, that situation or that issue with the recent financial engagement between CIMB and there's one of the company, Genting is a big public listed company in Malaysia, right? But I think they had one branch in overseas. I think in Hong Kong they call it. Is it Genting? I'm not sure the name of the subsidiary, but what the business activity is basically they do the tourism activity. They have this big cruise that traveling around the world, right? So CIMB previously have give a syndicated loan to Genting, right? Genting as a borrower here. I think the amount is not 10,000 like we saw. The amount reached trillion, right? Because it's syndicated loan. Syndicated loan is where all the banks collectively come together. They pool the money together. I think that they also involve Maybank, if I'm not mistaken, RHB, right? But CIMB was the lead arranger, right? So I think the huge chunk of money come from CIMB Bank, right? So at that times before COVID happened, right? So CIMB issued this syndicated loan to Genting, right? And then people came to surprise that CIMB issued this loan without any collateral, meaning that can you imagine this amount of this huge amount, right? 1 trillion worth of money. I think it's reached 1 trillion, or if not, it's 100 million. I'm not sure the exact amount, right? So CIMB issued this loan to Genting without any collateralized asset, right? Meaning if anything happened to Genting, they don't have any asset to recover, right? To cover back the money has been lent to Genting, right? So and then people say then because this syndicated loan took place before COVID-19, right? This is basically the good time. Economy is doing fine, right? People go travel every year. So banks become like Oprah said, or you can get a loan, everybody can get a loan, right? During this good time. So So no problem for Genting because what? So people came to surprise. Why you don't issue any collaterals? Because let's say I'm a retail borrower, right? So if I want to buy a house worth 100,000, even 100,000, banks are asking about the guarantor, right? If you have any asset to pledge, in the case of you being into bankruptcy and whatnot. So people who doesn't understand finance, they become puzzled, right? They say, why CIMB didn't ask for collateral? So it's a big gambling, right? But people don't understand. Banks during the good times, like I mentioned, they become like Oprah, right? Everyone get loan, right? So no problem. You come to me, I'll give you a loan, no problem, right? And then because CIMB has engaged with Genting previously, right? So that's the reason they don't ask for collateral, because they know that Genting is a good paymaster, right? They have a good stream of income coming from many sources. They have a casino, they have this. So should be no problem. Year until COVID-19 came, right? When COVID-19 appeared, nobody was expecting that you cannot go out of your house to do your job. And so economic activity has been suddenly disrupted, right? So this Genting company suddenly lose their money, right? It's because basically people are not traveling, right? People don't go up to the cruise and then travel around the world, and then so that was kind of unexpected, right? But people who doesn't understand finance and banking, they say that this is not ethical for CIMB to do that, because those are actually our money, right? Those trillions is actually our money, our depositor monies. How come you give a loan to with big amount of money to just one single company, right? So that's a very people say that is very irresponsible lending decision. But if you don't understand banking and finance, right? But if you understand banking and finance, this is basically a common practice, right? Because they know that they have engaged with this kind of customer previously, right? And then for them to issue a collateralized asset, so that's take another cost, right? You will incur transaction costs for you to do a documentation. And perhaps Genting even doesn't have an asset sitting idle that you can use as a collateral, right? So by giving this kind of syndicated loan without collateralized item, without any collateral, right? So it makes the syndicated loan become more attractive, right? Otherwise, Genting will go to other, foreign lenders, right? There's a lot of foreign banks that can offer the same amount of money. If CIMB were asking about the collateral, but in this case, CIMB did not, because that's basically how banking works, right? If you know somebody very well, you will become, partners, right? Rubbing shoulders to each other, right? So there's no worries for banks. So that's what I'm trying to say here, right? I mean, that's the function of markets here, for you to engage and then get to know each other well as a borrower and lenders, right? So that's just an example. I just mentioned to you earlier because it came across to my mind. All right. Any questions so far about financial markets, about this price discovery function of markets? Okay. Right. So that's we come to the last principle of money and banking. He's saying that stability improves welfare. I think I made it clear previously, right? If you are investors, like retail small investors, like in my case earlier, where I only have a few thousand, if few thousand is kind of a lot already, right? Let's say you have a few hundreds that to be invested in financial markets, right? So if the market is very unstable, right? If you, let's say you put the money in any financial instrument, today you purchase the financial instrument for, let's say, of 500s, right? And then suddenly you wake up tomorrow, you check you get your phone and to look at, I mean, how's the price of the asset that you have, or the financial instrument that you purchased yesterday. Suddenly you were shocked, right? You say that, oh, well, how come like I bought it for $500, and then today it's become like $100, right? There's a huge drop in the price, right? And then if I wait for let's say 1 more weeks, then the prices suddenly go very high, right? So you see that that kind of instability is very unfavorable to those, for us, like who is not you know looking for any potential big return. But what we want as a retailer is, we first remember the job of financial asset is to store and keep our wealth, right? Our disposable income, right? So that we can use it for the future consumption if we need it, right? And then the second job is basically just to give us stable returns, right? Otherwise, we might get into trouble as we might lose the investment entirely, right? Because we are not like speculators. They are speculators in the markets, and no regard about that, right? Because they are speculators who in the markets who basically looking to get returns from that kind of instability in the market price, right? So they are basically gambling on the price movement. So they are expecting that the prices suddenly go up in like by few hundreds, and then they decided to buy today, right? So, but they are speculating, right? That it might not get through, but there's no problem for them because they have the capacity to do that, right? But for us, like a normal household or normal, like everyday daily workers, right? We don't want that to happen. Otherwise, we are losing our spending, right? We might not get enough money to spend in the next month, right? So that's the job of financial markets, right? To provide you with a stability, which result in the well-being for the society, right? So let me just explain to you the. Are we supposed to stop now, or we should stop at 9, right? Because we start at 8. We stop at 9, right? That's true. Okay. All right. It's azan now, but perhaps I can just continue because we are rushing to this, right? So I put here, I said here that economic stability and social welfare are two-way street, right? What I mean by this is that they need each other, right? Let me explain to you this. On one hand, you have like this financial stability. But I hope by now you understand what I mean by financial stability, right? Stable price in the market. That's what I mean, right? And then on the other hand, you have welfare, right? Did I say welfare? Oh yeah, that's the word I use, right? So financial stability and welfare, right? So I think I mentioned the earlier part, which is you need a financial stability to help people to boost their social well-being, right? Because they can get more returns, stable returns, and then they can use for consumption, right? That's one street. Check that. Another linkage here is that for you to have a stable financial markets, you need a well-functioning society as well, right? So you need to have a social stability as well here, right? In order for you to have the financial stability, right? Look at the recent case of the war between Ukraine and Russia, right? So you see what happened to the financial markets, right? This is suddenly the Russian markets, collapse because people are getting out of money, right? I think the Putin has I think one time he decided not to open the market for a few days because he know that once he open the markets, people will just get the money out of the country, because people know that every country are against Russia at the moment, right? So you need what I'm trying to say here is that you need a well-functioning society. You need a peaceful society, right? Without any potential disruption for you to have this kind of financial stability, right? But at the same time, remember the earlier argument that I mentioned, that you to have the well-functioning society, you need that stable financial market as well. So that's what I mean by it actually a two-way street, right? They need each other. Financial stability and social welfare, they need each other. They complement each other, right? Okay. Okay, I think finally we end this first lecture. Are you clear with this 5 concept of money and banking, the principle of money and banking? Because otherwise I cannot move to another. This is very important, right? You need to have this mindset of banking and finance so that you are able to, grasp the understanding of when you're looking at different type of financial asset or instrument. Any questions so far before I move to the next lecture? Any question? You guys following any question about this 5 principle? Come again?
Yeah, the fifth one. What causes instability? What causes instability of?
What causes what? Instability?
Stability. We said that we need like.
A war.
What are the causes? The causes like the finance, the financial system being unstable.
What are the causes of financial being unstable, right? Okay.
Yeah.
So the basic way to answer that is that, okay. So remember that's if I want to answer to that question, right? You can relate to another principle just now on the financial markets, right? So when you have, let's say, put here in one this is like, imagine this is a financial markets, right? Okay. I give you, okay, let me give you two situations here so that you can see the difference, right? So this is financial. Just put a country. Let's say this is Kenya, right? Okay, like this is financial markets in Kenya, and give me another country. What? Let's say Maldives, right? Just put Maldives. No. Because they are both in the same income group. Give me a country, advanced country. Let's put UK, right? United Kingdom, for example. Right? So in Kenya, right? Because they are developing country, right? They basically the financial market or financial system that they have is slightly less sophisticated than the one that UK have, right? In Kenya, the participation in the financial market is very low. You can't deny this. It's not just Kenya, right? It's other country as well. It's other developing country as well. The participation level in the financial markets are very low, right? Perhaps they are. I give you a hypothetical example. Let's say in Kenya only have 100 people who actively trade in financial markets, right? While if you go to the UK, you have, let's say, 1 million people here, right? There are many people here who do transaction, who engage in the financial markets. You see the difference now is that because of there is a less people participated in the financial market. So you can you guess here which markets is highly chances or high probably will be more stable between Kenya and UK? Give me a quick response. Which is more stable in your mind?
UK.
In the UK, right? Of
UK.
course. In the UK, right? Because what people are, can you imagine the amount of the volume of the transaction here, right? Because you have 1 million participation, people in the financial markets. So they engage more frequently with a higher volume of trading, right? Because of this, high volume of transaction. So what happened to the information earlier? Remember the principle about the information? You will have more information in the markets, right? So when you have more information in the market, what happened to the price? To the price in the market, the price of the financial instrument in the markets, it become more predictable, right? Because people engage more frequently. Can you see the linkages here? I just try to explain by giving this simple example here. Can you appreciate how have that kind of situation where you have more people in the markets? People will do transaction more frequently, and then you see that there's a lot of financial information here, and then in terms of price, it become more stable here. In that sense, right? We
Quality.
Sorry, so come again.
Because there is credit quality.
Yeah, so but there's a different issue whether you have equal information or not, right? But what I'm trying to say here is the volume of the transaction, right? So that when you have more high volume of transaction, the prices become more stable, right? Unlike in Kenya, where you only have a few transactions going on, like very few less transaction that took place in Kenya. So what happened is that the market price has become a bit unpredictable, right? And then you will see they become more volatile, right? Let's say, for example, today there are let's say 80 people who do transaction, right? Tomorrow it become less, probably the next day become higher again. So it's because of this, less transaction or less volume taking place in the markets, it can lead to financial instability, right? So that's the job of, let's say, for example, we have a security commission in Malaysia, SC in Malaysia. You have same thing in other countries as well. The job of Bank Negara Malaysia, right, to make sure that we are living in this kind of situation, right, where we can have a stable price, agreed in the financial markets, right, so that you are not exposed to this kind of uncertain or unpredictable in terms of financial price. Okay, is that answering your question, Mahmoud? We're asking yourself, Mahmoud, right?
Yes.
Okay. Okay, right. Any further question? Anyone want to ask before I move? Okay, all right. So let's begin the first the discussion about the first component of financial system. I promised you last week that we're going to look at one by one, right? So today we're going to look at the money and payment system. Right? So what we will cover, we only have 15 minutes left. We're definitely going to continue this next week, right? So it's okay. I mean, we can start first. I mean, we can start with the discussion about what is money, right? You will see in a different people have different perception about money, right? Different imagination about money, different definition of money. Right? Perhaps economists have a different way to define money. Right? Regulators, governments have a different way of define money. Like for us who's spending money every day, right? I mean, for buying items, we have a different definition of money, right? Banks have a different definition of money, right? But we can come with some common, common element or common characteristic that we can agree upon, right? When it comes to money, right? And then after we define money, what is money? And then we're going to look at the functions of money. Right? What's the purpose of having money? Why is it so important for us to have this money, right? again, in the first week, I mean the first week, yeah, in the first week, I made a clear statement that financial sectors cannot be by itself, right? It is not similar with other industry. In the other industry, is okay; they can survive by their own, right? But financial sector, financial industry need to be in touch with real economic sectors, right? So what you see, what happened in the global financial crisis is that financial sectors were trying to detach from the economic activities, right? They want to be on their own, right? So by issuing those, sick and toxic financial asset, like in the case of CDO, remember we discussed about CDO, collateralized debt obligation. So collateralized debt obligation say that it's okay, we don't need an underlying economic activity that attached to the financial asset. We okay, we can issue the synthetic financial product or financial instrument to get a return, to generate a return, because we become greedy, right? Because we don't have enough sufficient economics activity so that we can use that to generate return, right? So that's happened to financial system at that time, right? And then when they try to detach from the economic sector, you will see it collapse, right, entirely. Right? So that's the tragic case of financial system at that time. So that's the unique characteristic of financial system. So same thing as money, right? Money is the instrument of one of the instrument in financial system, financial markets, right? So it's the same thing, right? Money has to be pledged, has to be attached to the economic activities, right? So we will look at this, how this money functions, right, within the economics sector, right? We're going to discuss that. And then after that, we're going to go a bit detail on how this money and payment system have been evolved throughout times, right? From the barter system that we have, and now people are talking about digital currency, right? And people are talking about NFT, non-fungible tokens. You have many other type of. To be honest, like we don't have any idea about that, right? Mean the evolution of money becomes something that is strange to us, right, as a common people. And then before we end about the discussion of money, we're going to look at the importance of money. I mean, how the regulators or the market regulators have a different methods or different way to measure money, right? It is important for you to measure money because it linked to the spending, right? When it linked to the spending meaning what? It linked to the prices, right? So you need to make sure that whatever money that has been circulated in the economy will lead to a price stability. Remember, I mentioned to you earlier, I think in last class, right? The function or the objective of central banks, right? To ensure price stability by having a control in terms of this, how this money has been circulated in the economic sectors, right? So that's all the discussion that we were going to cover in this second topic, right? So that's just an introduction, right? So now do we have time? We have 10 minutes more. It's okay, right? I can continue a bit, then we can stop, right? So we kind of, discussed this earlier about the beauty of having one common medium of exchange. In that sense, we're talking about the money or the fiat money that we have, right? Because we were born in this situation, right? Because imagine that if we were born in between the transition, right? Where let's say I was, or you yourself, I were born in the transition where people move from a barter system to a money, or this is called what we call as a fiat money system, right? So you will perhaps if you were in that time, you tend to appreciate the money, the paper money that we have a little bit more, right? So now we take it for granted because we were born in that environment. I think I think I discussed about the when you have when you work in a barter system is a very inefficient, right? Because you basically need a different price tag for a different item, right? So if you have a 3 item that has been traded in the one economy, but which is very impossible, right? You have millions or if not trillions type of item that has been traded in the market, right? So let's say you have a 3 is fine, right? You can have a 3 price tag or 3 price tag, right? So let's say you have a chicken and you want to exchange with milk, for example. So you have 1 price tag there, right? And then you have let's say another, you have let's say barley, right? So you have another price tag to exchange barley with what item just now? Milk, right, for example. So you have another price tag, right? So imagine if you have 100 items, just 100 items that have been traded in the economy. So you think how many price that we need, right? So you can, if you have a calculator, you can try this formula, right? So if you key in 100 times 100 minus 1 divided by 2, you will get some number here. That is the amount of price tag that you need if you are still in the barter system. You see that is very inefficient, right? That's one thing, right? In terms of having, price set in the barter system. It's very inefficient, right? The second way is that what I mean by double coincidence of 1 here. Let me explain to you what is a double coincidence of 1. That has been tackled or has been addressed by having the money as a currency, right? So back then when we have a barter system, let's say for example now I have chicken, right? And then I want to exchange with milk, right? So but what if at that time if I want to exchange chicken with milk, there's nobody want chicken, right, from me. So what happened? The transaction will not take place. Am I right? Because we don't have this double coincidence of 1s. You get what I'm trying to say? So if in a barter system, for you to do a transaction, you need to have 2 parties that are interested to exchange the good among each other, right? Between each other, right? Otherwise, it will not take place. You get what I'm trying to say? And then with that regard, he also want my chicken, right? Otherwise, we'll cannot be agreed to exchange the good. Am I right? But in the case of when you have a currency, so this is the time that you try to appreciate the money that you have, right? The currency, the paper notes that you have, right? So then now let's say we are in the currency system, right? Using a currency system. Let's say if I want to buy I have a chicken now, right? Because it doesn't matter what I have now, because let's say for example, if it's a matter what I want to buy, right? So now we have a currency system. Let's say if I want to buy milk just now, right? So with that currency system, the currency that you have now, do I need to wait until that person who has milk want to get my chicken or not? I don't need to wait, right? I can just issue this currency, this paper note, right? I can just give him currency, which he also can use later with other party. Am I right? You get what I'm trying to say? Is that right? Right? So you don't need 2 individuals who agreed to exchange the purchase. Sorry, you were saying? So you get what I'm trying to say here, right? With the currency that we have now, we becoming more economically efficient, right? Because I don't need to wait somebody who need my chicken for me to get milk, right? I can just issue the money, right? So you can see the picture here, right? Can you imagine if you have let's say now they don't have Tesco, they have what's the name of they changed the name to Lotus, if I'm not mistaken. So say you go to Lotus, right? So one day Lotus just made an announcement. So today we not accept any cash, but we accept items, right? So you need to bring all the onion from your home to exchange with if you want, let's say you want to get milk in my case just now, right? So I need to bring my onion, whatever, so that I can get my milk. Let's say it's not going to happen, right? So it's very inefficient, right? So that's the beauty of this currency system, right? So you can imagine, right, by not having the need of having this double coincidence of one, can you imagine what happened to the volume of the transaction in the markets? It will be multiplicated, right? The volume of transaction will go high because people can do transaction at any time they want, right? So you get the idea of this the transition between barter and current currency system that we have. Okay. Should I stop here because it's already yeah, it's already time. We can continue this next class, yeah. Before I end, any question that the most important thing is, are you following the discussion?
Yeah, I have problem with this lack of standardization for goods and services.
Which one? Oh, number 3, right?
Yeah, yeah.
Sorry, I don't go on. Okay, all right. Okay, let's say like this, right? So let's say I want something that is very specific, right? Let's say I want to buy milk. In that case, just now, right? Because let's say I want a specific type of milk. Let's say I want a low-fat milk, right? But at that time, that person who has the milk doesn't have that kind of specification that I want. So what happened at that time? There will be no transaction, right? Because I basically need to find somebody who has that low-fat milk that I want. So it become and then again the transaction did not take place because that item is very specific, right? But in the case of currency, if you have currency, you can go to anywhere using your currency to find and to purchase the item, the specific item that you want. Okay.
Yeah.
Is it okay, Muhammad?
Yeah, I'm okay.
All right. Any question before we stop? Sundus, you have a question?
No, not at that.
Okay. Anything else? Munira, are you okay?
Yes.
Okay. Amira, are you okay?
Yes, okay.
All right. If you have a question, don't be shy. Just stop me and ask a question. So let me stop here. Stop the recording. And we can continue the